Yesterday's comments from the monetary authorities in Switzerland and the UK reinforced the notion that Europe is well ahead of the United States in cutting interest rates. Thus, the dollar's dominant position will continue to be bolstered by divergence in the monetary policy between the old world and the new. In addition, concerns about the upcoming election in France are driving capital out of European assets and prompting investors to flee to the American currency as a safe haven. Interestingly, maintaining the US interest rate at 5% this year could exacerbate the already extreme situation for currencies worldwide, with Hungary, the Czech Republic, Thailand and China also poised to ease their monetary policies. The dollar stands to gain even more from these developments. At the same time, there has been an alarming increase in the number of emerging market currencies experiencing significant declines. Some of these currencies are in a much worse shape than during the Asian financial crisis of 1998. Turkey serves as a stark example of what happens when central banks lose control over their currencies. The country's inflation is skyrocketing, with the lira trading at its lows and the central bank's interest rate at a straggling 50%. Thus, the US dollar is getting support as the safest and most lucrative asset thanks to the differences in the policies conducted by central banks and political risks. That's why today the greenback is trading in a green against the currencies of the G10 countries, as well as a basket of 6 majors. Earlier today, the US dollar was hovering within the range of 105.50 to 105.90 points. Curiously, the US dollar jumped during the European session amid the publication of preliminary estimates of Eurozone's business activity. You can find out what events affect currency movements in a trader's calendar, which is now published on the eve of the next trading day. So, according to the initial data in June, Germany's business activity slid to 43.4 points. The data is well below the forecast of 46.4 and reflects the most considerable decline in the last 3 months. What's more, the Eurozone PMI may also slump to 45.6 points instead of reaching 48 points. However, the Eurozone services and the composite PMI are likely to be in the expansion zone. Analysts foresee readings of 53.2 points and 52.4, respectively. Nevertheless, the data will hardly prevent the greenback from a further rise. Moreover, the US dollar managed to gain in value even though the Bank of England kept the benchmark rate unchanged. The situation could be mainly explained by the comments provided by Bank of England officials. They said that the key rate would be cut at the following meeting, which was scheduled for early August. Despite a brief attempt to rebound following the Bank of England's policy decision, the euro retreated below the critical 1.07 level. Weak economic statistics from the euro area pushed the major currency pair into consolidation mode. On a Friday, the euro-dollar pair traded between the levels of 1.0675 and 1.0724, and during the European session, the euro came under pressure as the most preliminary business activity indexes indicated a slowdown in the Eurozone economy. As a result, the euro tested a 6-week low around the 1.0670 mark. In order for peers to maintain control of the market, the price needs to close below the level of 1.07. Otherwise, the euro-dollar pair is likely to drift in the 1.0700 and 1.0670 range. Despite overbought conditions, oil continues to trade at levels not since late April. The asset was supported by a report from the US Department of Energy. Data showed that U.S. crude oil inventories fell by 2.6 million barrels, and gasoline stocks decreased by 2.3 million barrels. Our analysts believe that the future trajectory of oil prices will depend on demand dynamics. If demand continues to grow, as it has recently, oil prices are likely to extend gains. However, the demand is likely to stabilize, thus preventing oil from a further appreciation. The market may have already reached its local high. In this light, the prices may start falling gradually, and traders are already selling off Brent futures within the daily range of $85.3 to $85.8. In the case of a downward scenario, the asset may drop by 2 and 3%. However, speculators may ignore technical signals that supporting the price momentum. Curiously, oil sometimes trades against the rules of a technical analysis. You have watched Market Review on the InstaForex TV channel. See you online on Monday.